have that conversation, please welcome the Chief Marketing Officer and Chief Sustainability Officer of Morgan Stanley, Audrey Choi.
Hello. Hi. Hello. Hey, how are you?
Awesome. Great to see you. We've been wanting to have you here for a long time, so it's great to finally make that happen.
Oh, it's great to be here. Thank you.
Start off with an assertion that ESG is the new SRI. And what I mean by that is that the space that environmental, social, and governance issues has taken is center stages is the central conversation in the way that socially responsible investing was a number of years ago. And not to diss SRI, it's still an important part of this. But it feels like, again, another sea change that ESG has kind of out of nowhere just found itself smack dab in the middle of Wall Street. Is that how you see it? You were in the middle of Wall Street, metaphorically. I know you're Midtown, but what are you seeing in this now? Has this changed?
I think what we're seeing really more than anything else is, is the momentum shift, that we really have entered sort of the hockey stick phase of the movement. I think there's a couple important things, though, to distinctions to make, right? One is that I think ESG really has become sort of the dominant term that everyone's talking about now. And again, just to level set, we're seeing now that if you look at all assets under professional management in the United States, that some sort of ESG mandate to them, it now applies to $1 out of every $4. So we really are now seeing 25% of the market saying they want some sort of ESG. So that is a sea change.
One out of every $4 that's invested in North America and
so
globally?
That's the U.S. numbers. Those are the most recent numbers. So it's about $12 trillion in the U.S. Globally, it's more than $23 trillion.
And this is money that's screened in some way for environmental, social.
So it runs the gamut. It could be that it's screened for not including negatives that people don't want in their portfolio, whatever that might be for you or your institution. It could be looking for general, sort of high-quality ESG criteria, all the way on over to impact and true impact investing, where people are really trying to drive for strong environmental, social outcomes alongside of financial returns.
You've said that today's ESG is not your mother's SRI. Explain that.
Well, it is and it isn't, right? I mean, I think one of the reasons that I would say it's not is because the SRI, I think, at least from a sort of cultural vocabulary perspective, it carries that connotation of if it's socially responsible, you're doing it out of this sense of virtue and that you are probably willing to accept a discount of, on return. I'm not saying that's what the SRI movement meant, but I'm saying that that's what for the mainstream market who weren't SRI investors, that's how they kind of successfully sort of said, well, that's maybe for somebody else. It's for religious institutions, it's for values-driven investors, but they're not really investors first. They're socially responsible first. ESG, I think one of the reasons that it's been able to accelerate so much in even just really the last 2, 3, 4 years, where it's gone from 1 out of every 9 to 1 out of every 6 to 1 out of every 5 to 1 out of every $4, is because right now ESG, the way we're talking about it really is, it's not just that it's investing in a way that is socially responsible. It's recognizing that thinking about the environment and the effects the company has on the environment, thinking about social issues and the effect that a company has on that is actually part of being financially responsible and being a good steward. And so you're seeing much more of really focusing on understanding that these can actually be financial drivers. And when you get that, you can start to embrace a whole different way of talking about ESG that may have SRI as a component of it, but that it's also saying these things actually, if you do it right, and those are some very important words, yeah. If you do it right, that you can really align financial value, risk reduction, and alignment with values.
Well, that begs the obvious question, what is right? What does that even mean?
Well, I think it means a couple of things, right? So I think right now, one of the biggest things is making sure that it's really done in a rigorous way. What we've seen is, look, not just financial markets, all markets at the end of the day are responsive to customer demand, right? And so when you suddenly see this huge surge in demand, I mean, as really evidenced by this incredible room, right? I think last year you were 40% less than this, and every year it seems to grow exponentially. When you see this kind of customer demand, you actually have a rush of suppliers saying, oh, if there are all these buyers, I better like put some product out there because I want you to buy my product, not somebody else's product. And so I think what we're seeing right now is that I think there's going to be a period of sort of a sorting of quality over the next few years where it's incredibly important for investors to think about, is this asset manager or this fund manager, are they really thinking thoughtfully about ESG along the lines of what I consider important? I, the investor, not me, and doing that in a rigorous way, or are they saying, look, here's a strategy they always run. You seem to want ESG, so I'm going to grab something that looks like ESG data, slap it into the formula, see if anything falls out, and then say that's my new ESG product, right? So we need to be careful about, really saying, how are you looking at environmental issues as a value driver? How are you looking at that? And then on the other side, also about impact, right? We want to make sure that there's two things we have to really try to manage for. One is that if an investor comes to sustainability and sustainable investing and has kind of accepted the notion that it's possible to maximize financial return and maximize outcome, and the two actually may potentially be mutually reinforcing, you want to make sure that's a good performing portfolio. At the same time, if they've come to that because they care deeply about climate change or poverty or whatever their issue is, that has to also be a strategy that is going to meaningfully deliver on that impact. And so we have to be really rigorous about thinking about what are the investors' goals, what are the issues that are most important to them, and what's the way to really do it in a deep, thoughtful, analytical, and meaningful, and strategic way.
When you talked about slapping some ESG data up there, there's a number of providers in the room, and I could actually feel them wince from all the way up here. It's been axiomatic in sustainability circles, at least for a long time, that analysts don't really care about sustainability. It doesn't come up in earnings calls. It doesn't come up that sustainability executives aren't invited to, with investor relations to visit, to meet with companies in any way, shape, or form. Is that changing? It feels like that has to change in order for this, what we're talking about, to really become real.
Yeah, no, I think it is changing, and there's also a perception shift. So just to get the two things separately, one is, look, I know that we partner very closely with our investor relations teams, and we get a lot of inquiries from our own investors about sustainability and ESG factors, and that is certainly being mirrored widely across the industry, where more and more investors, and look, when you've got Standard & Poor's and Fitch and Moody's all saying that they are actually now integrating ESG into how they're doing credit ratings, that is definitely going to be more on the minds of both investor relation executives and also chief financial officers. Where I think that sometimes there's actually more interest than people may think there is that people, especially on an analyst call, don't usually say, I now have a sustainability question I would like to ask, right? But they might ask something about your environmental emissions. They might ask something about your turnover rate. They might, exactly, and increasingly we're really understanding that those are sustainability issues, right? Retention, governance, environmental issues, those really are part of sustainability.
So we have a room full of corporate sustainability professionals. What do they need to know to be more successful in that exact conversation?
I think it's really more looking at sustainability as a driver of value, right? Because I think that as we go through this, this sort of cultural and sort of social shift that we're all in right now, I think the biggest mind shift is kind of that migration of sustainability as one of those things over here that that you had in sort of the pretty box, the sort of the Vaseline filters with the children in the playground and the trees and the hands holding the tree with the money coming off of the leaves, right? There's all those stock photos that we all have and that I say we can never use, and really pulling it over to how does it drive value. And when this, when the chief sustainability officer is able to be having more conversations about where is this a conversation that's relevant for the chief risk officer, for the chief financial officer, and ultimately for driving revenues, that's the kind of thing, and it takes a while. It really needs to build the business case. I know there've been some studies. I think that it's a number of different folks have done together, and I will get the numbers exactly wrong, but notionally right. Something like 95% of executives will say sustainability is an important strategic consideration. Right. Fewer than 60% of them have anything even remotely labeled a sustainability strategy. and fewer than, I think it's about 10%, maybe 12% have actually a business case around it. And, and then around, 10 or fewer percent actually report on material sustainability drivers. So there still is this huge gap between recognition and delivery.
So we talk about, a small percent actually having business case around it. What are you looking for there? What needs to happen?
Well, I think it really needs to be reconciling up what are the sustainability issues that really do matter to your business. So what we've done at Morgan Stanley, for example, is in our research division, issuing overweight, hold, underweight recommendations on stocks. We don't have a rating on your stock based on financials and then a separate sustainability rating, right? We're actually saying, if you're a chemical company and you're a transportation company and you're a financial services company and you're a software company, each of your industries have different things that matter for your business. And so so we've actually gone through and said, what are the dozen or 1 dozen to 2 dozen, not 574, but maybe the dozen or so sustainability issues that aren't actually today on the balance sheet, but probably should be.
Can you give an example?
Yeah, so look, if you're a manufacturing company and you're not actually looking at water usage, wastewater disposal, effluents, other things as part of the balance sheet, or if you're a professional services firm and you're not actually looking at the true cost of retention and churn. For example, we know that, we've seen time and time again, the companies that start to excel at diversity and inclusion and supportive workplaces end up having less turnover, which means they have less churn, which means they have fewer recruiting costs, which means ultimately their bottom line is better. So if you actually identify that dozen or so factors that are really, truly material for your industry, what we've seen is, and you then integrate that into the financial valuation, we've seen our analysts actually change calls, both up and down, as a result of that.
So talk me through how the sustainability professional in a company makes that happen.
I think it really just starts with understanding the business and thinking about what are those environmental or people factors that really determine, what's excellent about your business, right? And so again, and then figuring out, if we move the dial on a certain set of policies or actions, how could that impact?
So I think, let me restate the question, because I think a large percentage of people in this audience they already know that. I think it's how do you bring that to make sure it's integrated into the investor relation conversation and actually made part of valuation. Mm-hmm. I think that's where the challenge is and maybe some of the blockages.
Well, so no, look, maybe why don't I give you an example of maybe one case, and this is a couple years old, so this is not advice that you should go out and trade on, and I'm not giving you any stock advice here, but an example of some of the calls that we saw our analysts change and sort of why and how that materialized, right? One up and one down. So in one case, there was an analyst in a sort of a heavy industrial sector, and it was always known that sort of one of the companies that this analyst covered didn't do the best job on environmental stewardship and social stewardship. But again, when you're sitting there looking at a 13-week earnings call and a 12-month sort of call, it didn't really ever seem totally material. When they kind of went back in partnership with the sustainability team and research to say what could really actually drive the business, they were saying, there's always been this issue around water usage of this company using a lot of water from this local market, not really sharing that well with the local community, and it never had been sort of really that material in any one quarter. But they saw that the cumulative effect was that it was very likely that within a short period of time, like within that next 12 months, the local government might actually order them to do a feasibility study for a desalination plant for water purification, which meant that there could suddenly be an unanticipated capex of $500 million to $1 billion, right? So suddenly, water usage is a material risk. And at the same time, the community engagement hadn't been terrific, which again hadn't seemed material until you realize that it's the local community members who do things like give you permits to open new sites. And when the permits were coming ever so slower each time, it meant that their output was actually going to potentially be down up to 20%. Yeah. So you can say it's a water issue and it's a social issue, or you can say it's unanticipated capex and reduced volume and something that led to a downgrade. On the other hand, there was another company that had always done a great, different industry, had always done a great job on women's empowerment and community engagement and girls programs, and everyone thought that's lovely, and they got the sort of pat on the back until you went back and you looked at it and you saw that over the years, that track record and reputation of girls' education and empowerment, of inclusive workforce procedures and whatnot, led to them having lower churn rates, higher retention rates, higher productivity, and actually led to a financial upgrade.
Well, that gets to another question I want to get to Heather in a second, but we had, as you know, Audrey, we had this GreenBiz summit this morning, 100 people, including, I think, someone from Morgan was there, and we had CalPERS and CalSTRS and State Street, and it's really great group of both on the investor side and the corporate side. And one of the things that sort of astounded me is when we went around and had answered a bunch of questions as groups and reported out, is that so much of the takeaways were about communications, about definitions, about shared understanding in between the investor side and the sustainability side, and even just terms that like risk. How do we define that? And it turns out that don't necessarily define that the same way, probably sustainability even. So what have you learned about sort of shared language and communication that can be more, help sustainability executives be more effective?
No, that's a great point, because I do think that so often we're sort of talking past each other. I think it really, I think about it a little bit like, when you're an exchange student in a foreign country, right? And it's about sort of figuring out that local parlance and the accent and the right way to, be understood is, I think that just the more that we as sustainability leaders are really adopting sort of a financial and a true sort of business driver vocabulary. And we're not talking about, and we're being clear, look, there are a number of sustainability issues that really impact reputational risk. And being clear that that's a reputational risk, which also, frankly, can have real financial risk, as we all know. But then there are maybe others that really are operational risk. There might be market risk. There might be credit risk. And starting to talk about those things pretty specifically. The other thing is sort of starting to make what feels like large cultural anthropological issues, make them feel real from a customer perspective, right? So, for us on the wealth management side, I think one of the ways that we've managed to sort of focus the mind of our business on sustainability as a business opportunity, not just sort of a reputational issue, is really looking, obviously first the 1 out of 4 hugely helps, right? Every time I talk to a wealth manager, I say, okay, raise your hand if you want to cap your market potential at 75% of all of your clients' money. Right, and shockingly, no one raises their hands. So it's like, okay, so if you want that last 25%, here's what you have to get smart about. But the other issue is, and when we look at the future, right? And we know that there's, depending on which study you like to look at, 25, 30, $40 trillion worth of wealth that is going to change hands over the next decade or so, from largely male boomers to basically to women and then to millennials. And when you then put that against the chart of interest in sustainable investing, we see that today men are about 67% say they're interested in it. The first time we did it, it was about 66% men, 75% women, 84% millennials. Two years later when we did it, it was 67% men, 84% women, and 86% millennials. When you start realizing that millennials are now the largest cohort in the workforce, that they are entering the C-suites and the management ranks, they will be running the future, the future 50. Maybe not, they're not running necessarily the Fortune 500 today, but they will be managing companies of the future. Like, in what other universe would a CEO or a chief revenue officer say, you're showing me demand curves that go like this, you're showing me curves of where the future demographics of my customers are going, and I have no interest in integrating that into my business plan?
Yeah. Well, I hope it continues to actually get that, because it seems like it's slow moving, even though it seems to be taking off a little bit, accelerating. But anyway, let's get to a quick question from Heather.
Can you hear me this time?
Yeah.
Okay, great, thank you. I sort of building on where you've been. Much of your comments have been related to reducing risk, and using these issues to making sure that in the future the company will be around. And to your point, what about opportunity, right? How can you use these issues as levers for change? And innovation and so forth. So the question was, is it right now just really that the conversation needs to be about risk, about climate risk, and that's where we're going to make an impact right now? Or are you seeing examples of the counter argument, which is to say, let's go into the boardroom, let's talk about how this can be a lever for differentiation, for innovation.
Mm-hmm. Yeah, no, it's absolutely both sides of the coin. And actually, I usually spend more time, frankly, talking about the sort of the opportunity side. And I think a lot of it depends on, sort of where you and your company are on the journey. We've found that, again, at different times, at sort of different stages of the journey, and also with different counterparts, you may have more traction with one or the other. I think that often the sort of risk avoidance is where people are sort of most likely to first believe it. They can see that if something doesn't go boom in the night, that reduces, liability. They sort of get that. But I think, to the innovation point, that's absolutely where, and I think that's actually a big part of why we've seen a lot of the dollars move, is that people are seeing that it's not just about avoiding negative, that there are actually very significant growth opportunities. And again, I don't think you have to be a rocket scientist or a crystal ball kind of, clairvoyant to talk about the opportunities. You just look at, again, just pretend that we aren't talking about sustainability and just look at supply and demand curves. Yeah. Population moving towards at least 9.7 billion. The associated increases that means in not only demand for food, energy, and water, but also affordable quality housing, affordable quality healthcare, affordable quality education, and all of those things are massive growth opportunities, right? That could collectively be, very significant part of global GDP. And that is a huge opportunity for entrepreneurs and allocators of capital to say, I want to be in the fast-growing opportunity for quality, green, affordable housing in places like India, where you've got these exploding population trends and huge needs. So I think the opportunity set is definitely one of the big pulls for investments.
Well, I heard the word opportunity about 8 times in that answer, and I think that really is the driver, that the more we can equate sustainability with opportunity in the investment world, I think the faster and the further we can go in this community. We're out of time, not out of questions by any shot, but a great conversation. Please join me in thanking Audrey Choi.
Thanks so much, everyone. Thank you.
Thank you all.